Well, first off, I think that investors believe that the worst is behind them. We continue to get better than expected economic results, and so I'm calling it a better than expected, or BTE, bounce. So with the data coming in better than expected, I think investors are not anticipating a sharp retracement or digestion of these gains. Also, with interest rates remaining exceptionally low, that investors are saying, where else am I going to go? And using intrinsic value models, they're basically implying that the S&P 500 could be higher by the mid to high teens 12 months from now. And then lastly, we're entering into the second quarter earnings reporting period. It probably couldn't look any worse than it already does, down 45% for the overall market. So investors are saying, tell me something I don't know. If I'm going to be surprised, it's likely because earnings will come in better than expected. Individual investors, should they choose individual stocks or should they choose funds? That really depends on them. Investing is a journey. Do you want to do the driving, or do you want somebody else to do the driving? If you're happy to have somebody else do the driving, then you invest in a stock fund, because then you can match it up with your risk tolerance, your time horizon, your risk characteristics, etc., and select a fund manager with a good track record. If, however, you enjoy doing the work, well, then you're better off buying individual stocks and monitoring it and acting upon changes to the economic backdrop on a daily basis. Most investors today, while they do have money invested in the stock market, do so through 401ks or other types of retirement plans. And through those plans, most of them only allow them to invest in stock funds. So while the investors themselves are investing, they're doing so by having a professional intermediary. Those people who use services like Robinhood or other trading platforms, unfortunately, they're learning very quickly what their limitations can be, and they're finding that Robinhood and others might end up robbing from the poor rather than from the rich. So you have to know yourself first, and you're better off practicing with trades before you actually commit hard-earned money. One thing that is of consolation for an investor is that nearly 80% of the sub-industries in the S&P 1500, and there are close to 150 of them, are trading above their 10-week or 50-day moving average. About 40% are trading above their 200-day moving average. So the trend is your friend right now. And yes, while the market is up more than 40% from the bear market low, it's still below where it was on June 8th, when it was above by more than 45%. The larger cap stocks within the S&P 500 tend to garner the greatest amount of attention because they are in high growth industries like technology, or because they are high growth companies within otherwise staid industries such as automobiles with Tesla. Investors have to realize that while these stocks could undergo parabolic moves higher, at the same time they're also likely to be exposed to a greater amount of risk should the market decide it's willing to sell. Actually, the financials were among the three sectors that fell the most in this most recent bear market, and are among the three that are the better performers since the bear market low. So typically you can have groups such as financials, which might be looked upon as being fairly stodgy or slow moving, but because you've had a lot of the Fed and Treasury requirements that could be holding them back, etc., they can be subject to increased volatility. So utilities, healthcare, consumer staples, they're the ones that are traditionally called defensive stocks because the demand for the products and services remains fairly static, whereas industrials, technology, consumer discretionary, and even financials are cyclical stocks and could therefore have increased volatility, but end up doing better when interest rates are low and the economy is expanding. We are in the second half of the year now. Historically, when we have had a negative first quarter, followed by a positive second quarter within a presidential election year, the market has been higher in that final 6 months of the year. Really what investors are also going to be looking at is what is likely to happen with the upcoming election. Traditionally, the market itself can give investors a good idea. Since World War II, whenever the market has fallen in the August, September, and October timeframe, then the incumbent has been replaced. If the market has risen, then the incumbent tends to be re-elected. So we can see what the market's action is to give us an idea as to who will likely be elected or not elected.